Okay, good afternoon, everybody around the world, and thank you very much for joining this exclusive Riskura webinar on unboxing the Chinese consumer. Those of you who've been following the firm for a while will know that we had a similar themed webinar about 5 years ago, also on the Chinese consumer. But I can say from personal experience that the intervening 5 years, an incredible amount of innovation and development have happened on the Chinese consumer scene. And also, the Riskura investment team has just returned from one of our ongoing research visits to the mainland, to Hong Kong, and really the amount of stuff that we discovered and learned with a specific focus on consumer was really incredible, and we're very keen to share all of that with you this afternoon. We have an agenda that covers broadly three topics. So as promised, we want to take you behind the scenes of a series of Chinese consumer business models, really explaining why a lot of Chinese companies have been very successful in penetrating various segments of the consumer model, to then have a look at where artificial intelligence and robotics plays into all of that, because they really enable the production, the innovation, the rapid development of new consumer products, as well as other products, of course, as well. But really, that's been a key area of success for the Chinese economy. And then finally, just to give you a couple of words on how to actually access that opportunity. For those of you less familiar with Riskura as a firm, just giving you a brief overview. So we are one of the world's largest, probably the largest emerging markets focused investment advisory firm, doing both investment consulting as well as offering some multi-managed solutions, about $170 billion of client assets that we advise on, and about $1 billion of assets deployed to China directly, which includes both public markets as well as private markets or venture capital markets. We've been researching the region since 2013, so over 10 years. We're joined today by several of our specialists who are based in the region, including Robin Yu, who's our investment research specialist based in Hong Kong. We also have on the line Faisal Rafi, who's our head of investment research based in London, as well as Jared Klansbeek, our founder, who's probably familiar to many of you, who will all sort of chip in and contribute as we think appropriate. So I'm going to hand over pretty quickly to Robin in Hong Kong, to give us that sort of behind the scenes view of the consumer sector. And I think all I can say before I hand over to Robin is, personally having come back from that trip, there's a lot of really exciting stuff that's going on in the Chinese market, and I do hope that the next hour gives you guys a chance to experience that with us. Robin, over to you.
Thank you, Lars. Thank you, everyone, for joining us today. Let me start with our main takeaway. We believe there's a strong long-term investment case for Chinese consumers. First, consumption will play a bigger role in the Chinese economy, from 40% today to closer to 60 to 70% in the developed world. But what's more interesting is that Chinese companies not only taking market share from global competitors in the domestic market, but they're actually actively expanding globally. These companies are not simply copying what has worked in the West, but more than that, in many cases, they're actually enhancing and even reinventing the business models and the whole retail experience. So let me walk you through a couple of examples to show you what I mean. I think we have the coffee chain as the first case study. So when China opened itself to the world in the 1990s, there was an influx of established global brands such as McDonald's and Coca-Cola. They benefited so much in the early days because there was so little competition from the domestic players. Things have started to change over the past decade. Across the board, we see local brands displacing global competitors. They offer the same quality products, but at a much lower prices. Coffee is a great example of this. So Starbucks came to China back in 1999. It took them 25 years to build a brand and to reach 8,000 stores today across the country. They were the market leader just until a few years ago. But now they have been overtaken by local brands, including Luckin Coffee. Their market share has declined from 34% in 2019 to just 14% last year. And in fact, very recently, Starbucks has to sell their control of the China business to a local PE firm and try to turn things around. So Luckin Coffee is the brand that I would talk about. It's only started in 2017. Today, they have 30,000 stores nationwide, and they sell over 4 billion cups of coffee in a year. So how did they beat Starbucks? First, they offer the same quality of coffee, just as good as you can get from a Starbucks, but at half or even 1/3 of the price. And to do that, they need to find ways to cut cost. Their stores are small and super efficient, and the whole process is totally digital, from pre-ordering online, pick it up, to payment, it's all digital. And they also enjoy the economy of scale on raw materials and really efficient logistics that China market can provide. And they are being very innovative. They very fast at coming up with new products. Just last year, they've launched 150 new drinks, different various, hot, cold, with milk, without milk, but different various types, 150, compared to Starbucks, probably like 40. So in terms of product innovation, that's a huge edge over the global player. Maybe let's see a video of it. So very nicely done coffee, just as what you would expect from a Starbucks as well. The store, in a very efficient manner, grab and go. You can see the kiosk. It's very small format. There's no place for social, no place to sit down and keep it, just selling coffee itself. And this is one of their famous multi milk latte.
Just to interrupt while you're talking, I've had one of these multi Luckins. They are delicious. It is really, really good. But maybe just to say one other thing. I think Robin said that, and this is really about competition in China. The competition is insane. And the whole Starbucks story is not a drive-by. Someone's not coming looking and taking things away from them. What they are actually doing is they're speaking to a company called Boyu Capital, who are going to take over 60%, so majority shareholding. Starbucks keeps the balance, because this is a model that Starbucks have used in other countries where they've suffered. These guys will come in, revamp the business, revamp the product line, revamp everything so that it's far more Chinese, and go ahead with that business. So this story is not over. There's number 2, 3, 4 coffee. There's Manna. There's a whole lot. So these guys are way underserviced on coffee, and so that whole market is growing while you're getting these movements in market share. But really, really interesting. And all these opportunities are accessible and available. Quite phenomenal.
Yeah, it's phenomenal. Their share price is up almost 7 times since 2020. And over the same period, Starbucks actually, their share price declined 13%. In the last 5 years. So it tells you the story. The next company is Mart. And I'm sure most of you are familiar with Labubu. The puff toy went viral all over the world. So Mart is the company behind this. They own Labubu and also a bunch of other IPs. So today, Mart is everywhere. They operate over 2,400 robo shops and also 530 retail stores in over 100 countries. You can see that. So the pictures on the left, it's a Mart store in Shanghai, and on the right is the picture was taken at a highway rest stop in the middle of the country when we were on the trip. I think we have some more pictures coming up. Yeah, so this is a Pop Mart. You see the same Pop Mart vending machine in London and also in Paris. There's this big Pop Mart store in Paris, which is fascinating. The brand only started back in 2010. So the turning point for them really came when a couple of international celebrities were seen with Labubu dolls clipped onto their handbags. But it was no luck. It was done through careful strategy of celebrity endorsements, social media marketing. So it just didn't happen overnight. It looks like it happened overnight, but it's done through a lot of hard work and effort that go into it even before that. Just the Labubu alone is expected to bring in about 1.4 billion US dollar in sales this year for the company. So at the core, Pop Mart is really an IP platform. They actively scout and collaborate with artists, creative, talented artists globally to come up with new characters. And these artists who create these characters, they get a share of the revenue. So that's how they incentivize to keep working with Pop Mart to generate, to give them the greatest arts that they can create. Maybe we can play a video of Pop Mart to get people, so people can get a sense of that. Yeah, so this is a collection of all the IPs: Labubu, Crybaby, Skull Panda.
Maybe just to add on this, you may look at me badly because I know a lot about these dolls, but I have a 12-year-old daughter, and just understand the whole Labubu mania had people fighting for these dolls. Now, if you saw that IP earlier, these are, and you can see in these pictures, they're ugly trolls. I mean, they're not the prettiest dolls in the world, but they're highly popular to the extent that people were fighting over these in New York. And I find that quite insane. But what is interesting, because that's what you need to worry about a business like this, is how does it evolve? How do they keep on? And when you're talking IP, what's really interesting about this is all they have to do is bring on more and more famous artists to put things together. And the line of artists who'd want to actually earn this income is probably as long as the line of people trying to buy Labubus. But just to prove how that's working, the latest fad is something called Twinkle Twinkle. It's a far more, if you like, I'd call it humanoid. The face is more human as opposed to the ugly troll, and a very young baby. And that there now accounts for, what is the number, Robin? 8% of revenue. So it's not insignificant. It's not only Labubus. And so we've moved from the place of worrying about one kind of doll, which is very faddy, to something where you're now saying, well, how do they re-engage the brand, bring in different IP, and what do they do? And then it goes further. That you've got the big dolls, you've got the huge dolls where it's big once-off, and then you get a lot of the small little things, which I would almost see as gifts for kids' parties. It's a small little thing. I mean, the expense level of this is crazy. You're paying 69 yuan for a little toy this big, which couldn't have cost more than 2 or 3 yuan to actually make, or renminbi. It's just an insane model. But the key is, can they roll over? And as long as they've got the long queues, and as long as they've got the influencers doing their work on re-engaging, I think this thing could last a little bit longer than most of those fads, which most of us on this call are used to over the last many years, which just come and go.
Jared, I can see you're already an expert of that.
I am. You know the boss in my you know who the boss in my house is.
He has small children. He can't help it. Yeah.
And if people have a chance to visit their flagship store in China, it's a fascinating experience. It's more than just a toy store. It's decor, it's displays, so creative and so attracting, eye-catching, especially very appealing for the young consumers. And Pop Mart's share price has gone up 10 times just in the last 2 years. and driven by strong business results instead of valuation multiples re-rating. Their sales are expected to quadruple this year. And this is after more than tripling already last year. So it's huge, very fast growth for a company in China. We can maybe move on to the next case. Okay, so yeah, the next one is about the rise of domestic luxury brands. This is a picture of the IFC mall in Shanghai, and there are hundreds of these premium shopping malls across the country in a place dominated by European brands, the high-end luxury space. You will probably be surprised to see a local name alongside them. If you can just play the video on the right, you will find a Chinese name at the end of it.
Doing our best. There we go.
Oh, it's not. Yeah. It's working.
Yeah, so this was actually a video that I took personally in that shopping mall, leading up to the front door of a Chinese high-end retail store.
Yeah, so that's Laopu Gold. It's in Chinese, it's old store goldware, Laopu Gold. Maybe we can play a video of learn about what the business does. So it's a high-end luxury jewelry brand focusing on goldware. They use traditional goldsmithing techniques. Some goes back to the imperial days, and create this luxury feel and sense of feel. And you can see the stores are very elegant, very nicely set up. They really have learned the best from the West and also add the Chinese characteristics to it. So people call Laopu the Hermes of gold in China. In the luxury space, it's not really about the price anymore. So when we talk about Luckin, it's probably about price, compete on price. But in the luxury space, it's the consumers care about the design, the product quality, and the brand image. And we have seen that Laopu has been taking market share away from the big names such as Cartier. In 2024 alone, Laopu grew its sales by 166%, while some of the global competitors, global brands, they actually see sales shrink in China. So we can see that on this chart. You can see Laopu, just one store in Beijing. It's called SKP. That store, their annual GMV for Laopu is 800 million RMB, so roughly 110 million US dollar. That's much higher than other, the European jewelry brands, Cartier, VCA, Tiffany, and the numbers on top of each bar is the year-over-year growth, and you can see that Laopu is growing at 120%, while the other brands really suffering in China. So what's driving the success? There's number one, there's a demand for authentic cultural products, which was untapped by these foreign brands. So Laopu was able to find that white spot. And number two, their product design and quality really stand out. So consumers love it. And their marketing strategy, sales strategy is quite unique. For instance, their sales staffs are paid high fixed salaries instead of commissions, which means every customer gets the same great services, not just the regulars or the big spenders. So that's how they are taking a different approach from what the Western brands have been doing. Since its IPO just last year, the company's share price has already increased more than 8 times. I think we can move on. Yeah, so I would like to do like a quick recap of what we just have seen. So why is this happening, and why we think there will be more successful companies in the future? It's quite simple. The reasons behind their success can be repeated. So China has the world's second largest consumer market, and the consumer behaviors are rapidly evolving. There's low barriers to entry for newcomers in China today. The e-commerce has leveled the playing field. Supply chain access is now easier for domestic players. Marketing and brand building have been democratized through social media. There are many smart and ambitious Chinese entrepreneurs. Some are serial entrepreneurs, like the founder of Xiaomi, which we will talk about. Some are experienced product managers trained at the global companies, and some even from a very different background. The founder of Laopu Go, he was a clerk in a local fisheries bureau. It was just his hobby, and he turned a home workshop into a multi-billion-dollar business just in 10 years. And we think what's different today, make it very different this time, is that once they gain the scale in China, they're also expanding to global markets.
Yeah, I think just as a reminder that a lot of these consumer brands have come out through in the hardest time that the Chinese consumers have faced and the Chinese economy has faced, since the beginning of modern China. And why is that the case? We were reading in the news going, China's suffering, Chinese consumers are not spending, and then we see these brands that have emerged quietly, at least to our eyes, and they just came out from nowhere. And it's really got to understand these entrepreneurs who are using what China's phenomenally good at. So somebody coming out of Procter & Gamble, we met a CEO of a dog food store, basically dog food, and he came out of Procter & Gamble where it took 9 months to just get an approval to change the coloring of some packaging. So a lot of these entrepreneurs coming out of these global companies going, we can do this much better, much quicker, much cheaper than the global competitors, and eat their lunch. And that's what we've really basically been seeing. And they're very much in tune with the supply chains, but also with the consumer. So using all these TikToks and the social media, these companies get instant feedback from the consumers on, we don't like the color of this, we don't like the design like this. And then there's an immediate, almost kind of real-time feedback to redesign, take it back to the supply chain, and reconfigure the product until it's perfect. And once you dominate the Chinese market, then globalizing is very, very, very straightforward and very simple for a lot of these guys. And there is a science, there's a logic to this madness of why we're seeing a lot of these Chinese consumer brands coming through. And we believe that this is just the start.
I mean, I want to add something, if I may, Robin, just to this. You got these young entrepreneurs, but also all of this other stuff. There's the thing that people think, and they always remember the Chinese were very effective at copying things, and you may discuss that a bit more. But the best case that I've got is many of you. I mean, we all own cars, right? And if you think of the Range Rover, now you all know of BYD. You've heard of Build Your Dream. We're not discussing it, but I want to give this example quickly. So if I went to the place and they had this beautiful car, it felt like a Range Rover or one of those top-end Land Rovers. I mean, it looked exactly, it had everything except it was half the price. Now, here's the catch, because there's no innovation in that, other than practically having a kitchen in the back. This thing, if it gets stuck in a river, so you're paying half the price, it gets stuck in a river, it floats for 30 minutes. It floats. So when you think of Chinese cars and all of this, there's innovation where the guys are just coming in with these amazing things. And many of your markets will ultimately get this BYD, but when you see the big Range Rover thing come through, you're going to be horribly shocked, because actually it does a lot more for half the price than really what you're experiencing. And so when you get to companies in cars and EVs, and you can see everybody saying how they're just killing everybody. Well, BYD is not over yet, and I do want to point out one thing: their margins overseas are probably 3 times higher. This is not dumping. Their margins are 2 to 3 times higher than what they are in China. In some cases, like BYD, its margins in China are negative. Its margins offshore are plus 20, 30%. That's where they make the profit. So moving overseas, once they've fisticuffed through 100 EV companies and ICE and hybrids, they get to the other market, and competition is like being in nursery school. These guys get in, compete, and they do very well.
That's right, Jared. That's a great point. So it's not that they're willing to expand. Sometimes it's they must expand to the overseas market, and given their competitive position and the product offering. Next up, we have a good example of a Chinese brand expanded successfully through acquisitions. So Anta Sports is already the world's 3rd largest sportswear company. Using the profits that they make from the domestic market, it has been buying the well-known foreign brands to accelerate its global expansion. So some of these, we can see below, some of these brands you must be familiar with. It acquired Amer Sports in 2019. So that's the parent company of many of these brands here, including Solomon, Wilson, and Arc'teryx. And they just recently also bought Jack Wolfskin, a German outdoor brand, earlier this year. So let me take Arc'teryx as an example. It's a Canadian high-end outdoor brand known for its premium jackets and gear. You can see the video here. So yeah, you can see it's for performance, but in this shop, this is I think one of the, so this is the flagship shop in Shanghai. You can see very nice, beautiful setup and displays of the products. It generates $50 million US dollar sales in this one single store every year. And interestingly, a lot of the sales are generated online, pre-order, and customers just go offline to pick up their products. And this offers a whole new retail experience. And since the acquisition, Anta has done a great job supporting Arc'teryx, the growth in both domestic market and also internationally. They've provided the resources and the local market know-how to help the brand scale up its operations, open more new stores, come up with faster product designs, and also reach new customers through digital marketing. So in China now, Arc'teryx is, you can see that everywhere, especially in the tier 1 cities like Shanghai and Beijing. The popularity has gone up a lot. It has gone from a niche outdoor brand. Some people would call it like FISO. It's a long-term customer of the brand. At some point, it was a sleeping foreign brand, but now it's really revived into urban streetwear and a real status symbol in China, especially among the young professionals. So their jackets are now, selling out in some of the major cities in China. The numbers tell the story. Arc'teryx, their sales have surged 30% growth year over year in the past few years. In 2024, they report over 2 billion in global sales, making it one of the fastest growing brands in high-end performance outdoor categories. Guess how much Anta paid for it in 2019? They paid $5 billion US dollar, and today, after 5 years, it's a listed company. It's already worth 20 billion. So they make 4x just in 5 years by also helping the brand to grow and strategizing for the company. Okay. Lastly, I would like to show you an example of a multi-product brand in China. We all know companies like Apple, in the US that makes phones, watches, and laptops, etc. the Chinese company Xiaomi really takes it to the next level. Its products cover everything from smartphones, watches to home appliances, fans, air conditioners, rice cookers, vacuums, the list goes on. And they can all be connected in an intelligent way. So you can create a smart home environment. And the more recently, Xiaomi expanded into electric vehicles. So now you can walk into a Xiaomi store and not only buy your handset, and also you can buy a car. And for that reason, Xiaomi is regarded as the China's Apple plus Tesla. So let me share a story of the founder. Before founding Xiaomi in 2010, its founder Lei Jun was already a highly successful entrepreneur and a tech executive and also angel investor. He was already worth hundreds of millions US dollar at the age of 40, but he didn't just stop there. He was ready for a new challenge, which is Xiaomi, which is inspired by a desire to create a global leader in technology, combining both software and hardware. So as what we have seen, so the progress Lei Jun and his team has made over the past 15 years, it's phenomenal. Take EV as an example. It was the company only announced the EV business in 2021. The first model came to market in March 2024, and they're already delivering 400,000 units this year, which is very impressive by itself. And also the business, it's already profitable by the end of this year. So the target for next year is to deliver 700,000 vehicles. One of the investors with us on the trip, he was absolutely shocked by how cheap the Xiaomi EV car costs, 35,000 US dollar. He said, honestly, like with this level of quality and design, he would happily pay twice as much for the same car. So it's a phenomenal story, really. And also what's interesting is after the launch of the EV business, Xiaomi, the whole brand image has also been lifted up. So across all the business lines, they're now selling more premium products. So it helps with the margin, helps global expansion, etc. So this is one thing one story I want to share with you.
And just to add there, I was taken on a test drive in this car. And what's interesting is the first, again, on the innovation, is the windscreens are UV protected, which other people haven't really thought of, and which I thought was quite clever. But I tell you what was phenomenal is my son was with me, and he had his earphones in, and they put their foot down on the accelerator. So it's 0 to 100 kilometers, 60 miles, in 2 seconds. His earphones flew out to the back of the car. It was so fast. I mean, it's an unbelievable car. It's very Porsche looking, but what an amazing brand. And the pay point, very reasonable.
Okay. So
yeah, these are just a few examples. There are actually many more incredible Chinese consumer companies that were listed in the recent years, and this slide really summarizes it. Since 2020, there are 33 consumer companies got listed, a total of 130 billion issuance, and today they are worth 180 billion. So we can see even during the difficult time of the Chinese markets over the past, from 2022 to 2024, but actually many of these companies are doing great in terms of the growth and also share price performance.
Okay, Robin, thank you. That was a really good, quick summary of the innovative and in many cases very, very successful Chinese consumer business models. I want to hand it over to Faisal Rafi, our head of research, to just talk us through the importance of artificial intelligence and robotics. We kind of know that the Chinese, along with the Americans, are world leaders in that sphere. But really, let's understand, let's unpack a bit more how that matters, where the investment opportunities are, how that matters for the consumer products, and so forth. Faisal.
Yeah, thanks. I mean, just to make the note on the previous section is really that it's about accessing these opportunities early and and find them. And this is where I think some of our fund managers have participated and invested with these companies when they were private. Then when they listed, number of our fund managers like PopMart, at least three of our public equity fund managers actually participated in the IPO, and many further bought that stock afterwards. So one of the things we talk about is really China is such a big country. You really need to be on the ground and understand the changing dynamics and be there when the right time comes. Just before I start off speaking, I want to show a short video talking about Shenzhen, which is basically China's tech hub, and then and a few small and a number of portfolio companies owned by one of our fund managers. Lars? No sound. Well, okay, that's great. There was supposed to be sound to that, but I can give the sounding. So 80% of China's high-risk supply chain comes from Shenzhen, and you see 90% of the components come from 1 hour's drive. This is it's okay. We don't need to unmute, Lars. I can talk through this. This is why when people talk about China's supply chain advantages, this is what we're talking about. And this advantage is the one that countries like the US cannot replicate and have that have that research and development all in the same space, work with the supply chains and build cars quickly, redesign them, improve them. This is Pongbot. This is a company that's already very large in China, about to start exporting. This is Vitio. It's got the largest global share currently on augmented reality glasses. Strut, an incredibly impactful company. If any of you have family members who have wheelchairs, you will see all the marks it makes on the sides of the walls. Well, this company stops it. Limix is one of the many robotics companies operating in China, which we'll talk about. A lot of investment right now going into working on dexterous hands. This is kind of like the thing that we need to sort out if we're going to have humanoid robots in the next 5 to 10 years. Minimax, I'll talk about that later on. It's an incredible AI company that's going to list next year. Thanks, guys. Thanks, Les. We can move on. We can move on. Great, awesome. So the left coincidentally the headlines just this morning was China leapfrogs US in global market for OpenAI models. The DeepSeek moment in China was really the whole world got surprised in January of this year when DeepSeek came out with a large language model that matched the best in the USA. This was at a time where the narrative was that you need to have these cutting edge chips to have great models like ChatGPT. Without those, you can't make them, and therefore China will lose the battle for artificial intelligence. DeepSeek surprised the world by actually demonstrating the same level of performance by just making the computing power sweat harder in a fraction of the time that OpenAI did it. This really changed the world. Tech stocks globally crashed. They were worried about China's dominance in this space. It also created a huge change in the movement of Chinese stock markets. They started reacting very positively, and the China market has gone up significantly since then. It's also created an incredible amount of spirit among Chinese entrepreneurs that we can actually do this. One cannot underestimate what we call this as a DeepSeek moment, almost a nationalist thing. Why has that happened? If we just move on to the next slide. So all of the world's leading entrepreneurs like Mark Zuckerberg or Elon Musk say that this is a battle for talent. There's been very big news on the fight for talent as much as it costs. Facebook paying hundreds of millions to individuals to attract them, fighting between Tesla. But look at the ethnicities of where they come from. The chart on the left shows that a big percentage, actually the majority of top AI researchers in the world come from China. So this is why this is the battle of the Chinese from the US versus Chinese from China. The chart, showing Meta's dream team, mostly Chinese / Asian faces. Again, Elon Musk's dream team at XAI, once again Chinese. So this point has to be remembered that really all the top researchers, top engineers in AI and robotics are Chinese, which gives China a big advantage. Next slide. And so if we think about like the global technology value chain, the key thing to remember is there are some things that China is catching up on. So China is still behind on the actual science, the actual breakthrough that we had about 6 years ago behind the large language models that we're seeing, or say the chemistry on how lithium can be used to make electrical energy, and then subsequently how you can package it up to make it into an electric battery which supplies electricity. Those parts, China is still catching up. But where no one can match China's dominance is when it comes to engineering, taking that technology and put it into work and come up with a product that the customer want. This is what China has today mastered. And this is why China wins the AI race. China wins the robotic race. If we move on to the next slide. So you've seen that in the last 10 years, China came from nowhere and leading in what we call these new areas like drones, solar, phone, electric vehicles. China has already come from being a laggard to becoming competitive to become the leader. And many people already say that China will lead the war in AI too in 5 years' time. Jensen Huang of NVIDIA is only one of the many who said that, at a minimum, it's going to be a two-player race. It's just really, i.e., the USA and China. And why is that? Is really it does come down to the engineering talent. Next slide, please. So when it comes to LLMs, China has been able to match the 90% of USA performance at 1/10 of the cost. Until now, they've just made the computing power sweat harder. Now, going forward, what you have is more smarter chips coming in the US versus cheaper electricity costs, because these things take a lot of electricity, and US does not have enough of electricity. China has abundance amount of electricity, as well as the data. These are the two things that are very essential. You need the electricity and the data to train these models to come up with better models. And going forward, whilst better chips are still coming up, like the Blackwell trained chips with NVIDIA is going to lead to the next versions of OpenAI chatbots coming out. But going forward, they're running out of the data to train their models. They are going to struggle with the electricity. China starts leading in that space now. And that's why what you're going to get is these models are going to keep improving. And what you're seeing is that the gap between every time US comes up with something and and how long it takes the Chinese to catch up with, that gap keeps reducing, and it's going to keep reducing until they kind of match. On the robotics, it comes down to just the number of engineers. You know, they're 10 times the number of engineers, and they cost 1/7 of the price. Another very unique thing about these engineers is the Germans are very good at hardware. The Americans are very good at software. Robotics need both. Robotics need both the software as well as the hardware, all in one device or one thing. And this is where the Chinese are very good. This is actually one of the reasons why a lot of Chinese Americans are moving from America to Shenzhen. You saw that video, to pursue their ambitions, to pursue their ambitions, because they need both the hardware as well as the software, and that hardware comes into supply chains. It's all good to have, you know, a few robots being sold, but more and more, the supply chains will matter. The robotics supply chain, everything has to be rebuilt again. You know, the arms, the joints, all of these require supply chains to mass produce them. Those supply chains have been creating in Shenzhen right now as we speak. Sadly for the West, they're going to come up against the same bottleneck in the future, which is to have their robots. They're going to need to rely on the Chinese supply chain. And we've already talked about talent. We move on to the next slide. So Minimax is one very great case study that we have enjoyed. Our clients have enjoyed through investing in it and directly. So Minimax is kind of like a Chinese version of OpenAI. It is multimodal, meaning it's got multiple companies, multiple products that it runs. It's got an app that you know you can be friends with on your phone. You can talk to it. It calls you. You've got one of the world's leading video music generation. So text to video and music that is already being used by designers across the world to save them their design costs. They also work with companies like Tencent, providing them the engine behind their AI. This is a company that, you know, our clients would have invested about $1 billion. It is about to list at a much higher valuation, and if it is successful, then any consumer company, successful consumer company in China can get to hundreds of billions of dollars.
Faisal, maybe just to interrupt there. The first thing I would recommend everybody does is go and try chat to Talkie, just as an exercise. Unbelievable experience, but I'll leave that to you to do. What I would point out about and this is Minimax. Minimax, let's say it's valued at 3 billion now. You must recognize that there is in comparison to OpenAI, which is at 500 billion. 3 billion, 500 billion. Let's add all the AI LLMs in China, or companies with some basis in that. And then I'm not going to worry about the apps that flow on that. But if you add those, you maybe get to, what, 20 billion, 50 billion? Whatever the number is, it pales into insignificance when you contemplate OpenAI at 500 billion. So the possibility of price performance on these companies, given the mania all around the world, and given, as you saw in the FT article, where 17% of people are now, what was the percentage of in that article on people downloading Chinese AI? It's now bigger than the US. Then you start to say, wow, either the open AIs are coming crashing down, or these entities are going up tenfold easy.
The cost matters. The cost matters, especially if you're a business customer. So the billions of dollars being used to develop the US those companies have to retrieve those costs, and therefore they will always be more expensive than the Chinese versions, and that matters. And what people say is all the global South, the emerging markets, big countries, South Africa, Brazil, they will be using these Chinese LLMs because they are going to be more affordable, and they're going to deliver 90% of the performance. If we just move to the next slide, I'm just going to wrap up by a quick one on robotics. Really, there is a multitude of companies building out robotics, from small startups to big companies like Medea and Hire, big consumer electronic companies also building out, car companies, Xpeng. Robotics is taking a lot of investment into China. Why is that important? Because that is building the demand to create the production and the supply chains, which is going to give China the long-term advantage in robotics. And as we switch over back to Lars, maybe Lars, if you just play 2 seconds of the next video, the Uni robot. You know, if we just move to the next slide, and just Unitree is the most successful robotics company in China. It is a fraction of the valuation of US leader Boston Scientific. It is also about to list next year. It runs all the way from industrial dogs to robots, and this is also a very global company already selling across the world. At this point, I'm going to end and I'll pass it back to Lars.
Thanks, Faisal. I'm actually a little bit disappointed that there was no sound on that video on Shenzhen and the supply chain, because I know you guys had a chance to see the visuals, but it really is absolutely incredible how quickly products can be made in the Chinese supply chain, from design to getting a prototype to getting it done a week, 2 weeks. It's absolutely incredible. I mean, it was a total eye-opener. The full range of products that are available, it's just absolutely mind-blowing. And so one of the questions that's natural is, well, how on earth does one access this opportunity? And so just to kind of compare a little bit, one of the natural questions is, how do Chinese companies compare to, for example, their US equivalents? Here's just a snapshot of the technology sector. So on the right-hand side, your typical Nasdaq 100 type stocks, Nvidia, Microsoft, Apple, etc. On the right-hand side, the Chinese equivalents. The thing that immediately strikes you is, one, how much more rated the US companies are, even though they're basically in the same industries. The average forward PE on that side is around about 36, so a little bit less if you exclude Tesla, which is extremely highly rated. On the Chinese side, it's around about 18. It's approximately half price. So you're getting a similar type of company, a similar type of industry, similar prospects at half price. Like that just is unsustainable. There's no way that makes sense to an allocator. So one of the key takeaways is that the entry point continues to remain extremely attractive.
And Lars, just to interrupt there.
Yeah.
I mean, obviously there are two things here. There's the price you pay for the earnings and the future growth. And the growth in China over the next 2 years is higher than the US. You'd expect, by the way, at double the PE to have double the growth, and that would justify it. It would put it in a more justified position. But you've got growth in China, and I'm talking across all stocks in China. Growth across China, twice that of the US, whereas PE's half. Doesn't make sense. Something's got to give. Either something else needs to come down, or by the and you can see it in these prices here. If your growth is higher, then there has to be normalization in pricing.
Yeah, no, Jared, you're absolutely right. I mean, these charts here, they go back a couple of years, but they basically, spotlight exactly what you've just said, that the Chinese, and to a larger extent also the wider emerging markets, have trailed the MSCI world, which is dominated by the US, which is itself dominated by a small handful of technology stocks. And on a relative valuation basis, the emerging market stocks, the Chinese stocks in particular, are just extraordinarily cheap. So there's a very, very, very attractive entry point for those. And one of the other things that one does need to take away from investing in emerging markets, and China in particular, is the essential necessity for being on the ground. So to follow the trends. It's quite difficult for foreign researchers to properly understand. Like, I'm not buying Luckin coffee. I'm not buying a Labubu doll. I'm not experiencing these things myself. And the same, I'm sure, is true for many other people who are living in the US or in Europe. Whereas those who are local find it, you're part of that ecosystem. You're watching the dynamics. You're watching TV. You're watching the social media. So there's extremely fast-moving dynamics. You've got to have somebody on site who's able to capture those, to figure out where the next trends are. Because we've learned a lot this afternoon already about companies that have been very successful. But really, what you want is the next company, the next Laopu Gold, the next Luckin Coffee. In order to identify that next player, you need to be on the ground, figuring out where are the trends, and where is that next growth coming from, and how can I participate in that. So having somebody on the ground, having on the ground managers, expertise is absolutely essential for making a success of a Chinese investment program. And really, just to kind of draw together, I know we want to leave a couple of minutes at the end for a few questions. Is if we sort of summarize what we've covered today. So we've got Chinese brands, Chinese manufacturers and product developers who are displacing global incumbents, whether that be in the luxury sector, where they're muscling in on the kind of Western luxury sales model, whether they be Chinese companies who are expanding globally, whether that be through acquisition or because they just have a product that's popular. So that is a trend which is almost certainly going to continue at a pace. The Chinese companies have the benefit of an unrivaled AI and robotics tailwind, the ability to develop products very quickly, to integrate with advanced self-guiding type technologies, whether that be for a wheelchair or with a self-driving car or a vacuum cleaner. The technology is there, it's on site, it's all local, it's very easy for them to incorporate that. And then if that isn't enough, it's combined with an extremely attractive valuation. So as we just discussed now, in many cases, it's half price for what you'd be paying for the same thing in a US or perhaps a European environment if the company existed. So putting it all together, it's a very attractive opportunity to enter, notwithstanding the fact that some of these companies have done well already. The ecosystem, the environment is just so favorable that there are going to be additional very, very successful companies coming out of this setup. Okay, just to leave a few minutes for questions. I was aware that the couple of questions have been submitted through on the chat. One question that we had coming through was about Anta Sports. So I might just pass this on to Robin, but let me just read out what the question was. So we know that Anta Sports has been very successful domestically in China, but what are the kind of prospects for the Anta brand itself actually expanding into Europe or the US? Whether it's purely competing on price or whether actually the quality of the Anta apparel or shoes is on a par with the likes of Nike and Adidas, who are kind of the world leaders in that space right now.
Yeah, thanks, Thomas. So very good question. The Anta brand itself is deliberately positioned for the mass market. So it has a focus on being cost effective. Okay, so it's not really about the quality of the products. I think they have invested a lot in designing the quality, but to build a premium brand, you need a lot of you need a lot of you need time and also a lot of marketing effort, capital that go into sponsoring sports events, sponsoring the top players, tennis players in the world, etc., to build that brand. So the approach that Anta is taking is a multi-brand approach. Okay, so they, rather than building, so they're still building their own brands, which will take time to get the global influence. But at the same time, they're buying the older brands, foreign brands at an attractive valuation, and turn it into reinvent the strategy, help them promote, help them sell to the 1.4 billion population in the domestic market, help them leverage China's supply chain, to make the cost more efficient, and also to get to a bigger audience and do digital marketing. So it's a multi-brand strategy. They are nurturing their own brand, but as well as through acquisitions of some of the global brands out there.
But maybe I can just add, I've been trying to write an answer which hasn't really worked out. What is interesting is, and I've been, if you look at all the brands, you've got Lululemon, you've got Gymshark, you've got a whole lot of lots of new brands all over the world, and they are all doing a lot of research on fabrics, so really what you're using. And you can even think of Hoka, which is maybe a little bit of an older brand, but certainly has grown quite. There's a lot of scope for these guys all to grow. And what they use, so for the likes of Anta, using 1.3 billion people to trade off, using influencers and a population that is completely comfortable on, if you like, in the West WhatsApp, but there it would be WeChat. And that's an entire infrastructure. You can start a business in a day on a WeChat. It is, I mean, if you go and experience it, it is phenomenal. You can get a whole lot of apps inside, but you can also sell goods. And that's really where it is positive. So they use the influencers, they use the people, they're buying in Western brands, which are maybe they can get a little bit cheaper because they've become stale. And you saw the example that was given earlier on that. And that allows them to grow and compete. We saw another one. I mean, there are these venture capital companies that know exactly what to do. They know how to invest, who to hire, and then get the influencers involved, get the researchers involved, get the marketing people involved, and they go and they create a brand. You've seen that with the bubble tea. You've seen that in all these interesting areas. Just over the last few months, you've seen listings. So I think this one could be good. But Anta is definitely well positioned because they are quality. They're on the main roads wherever you go in China, and that would be right next to an Adidas. They are doing what they have to do, and they're doing their own research and are getting to product where the fabrics are even better than the likes of Lululemon and the others who are obviously very high-end brands in the sports arena.
Thanks, Jared. Look, I realize we're a little bit over time. There's one question that's come through, which I think is probably on a lot of people's minds, which is, from a kind of governance perspective, whether the discount in valuations is warranted comparing Chinese companies versus US companies. So it's kind of a broader topic, not purely related to consumer. Faisal, I think, did you want to have a crack at giving an answer to that one? Before we close up, or Jared as well, maybe between you guys.
So I think a discount is merited for a lot of different reasons, which we can go into others. But China is an emerging market. It should have a discount to developed markets. How much that is the question we're talking about right now. We think it's extreme. And again, it comes down to also when it comes to allocations, when we say to our clients, you should invest in China, we're not saying to them, invest as much as you invest in US. If you think about it, putting everything aside, that's what you should do, because the size of the economies means that your largest exposure internationally after the US should be China. But of course, there are risks associated with China, and it's about how much you have of China versus not have anything. On the question of governance, I did want to, and I'm glad that somebody asked that question, because one of the incredible things about why these companies are prospering right now is because of governance, incentives, culture of the corporates. Every corporate we speak to, every CEO you speak to, from a heavy industrials, old economy company to a startup, they talk about establishing the culture in the company the right way, to incentivizing the people in the right way, employee ownership schemes, so that ownership is very much it's no longer only the founder having the majority of the shares and you align with the founder, but actually the ownership these days is spreading to much wider. The governance has improved significantly. Reporting is on par with the West, if not better. The Chinese stock exchange regulatory requirements are the same, if not better, compared to other stock markets. And then I think the last point I will just make is it's still anywhere you invest, you do need to know who you're going into bed with. So you do need to have local partners to actually verify the integrity of the entrepreneur behind the company, and all that's good. That is the same in South Africa, or a successful startup in the US. So all those things hold true in China as well.
And I just want to add to that. If you look at the S&P 500, the top seven, the Mag 7, they've had earnings growth which has been through the roof, and their PEs trade at an average of 30. The balance of the US, the 493 stocks, that trades at a PE of 19. Now, if you look at earnings and earnings growth of the developed markets outside of the US, and you compare that to the 493 stocks, they've been indistinguishable. So if you look at earnings over time of the balance of DM versus US outside of the Mag 7, it's the same. Yet, by the way, you can buy the developed markets at a 14 PE, which is a 30% discount to US companies doing the same thing. And yet the US is not growing as quickly as one would want, and certainly not growing as quickly as emerging markets in China. So if you look at that, the balance of the developed market, they are priced far more like China and emerging markets. Their performance has been pretty indistinguishable as well. And you didn't see that in the graphs that we showed before, but there's another version where you take out China out of EM and you take out USA out of developed markets, and they've grown the same. So the big thing is that China has halved relative to the US over the last 4 years or so. It is too cheap. The premium is ridiculous in that sense, and especially if we're in the world where the US is really fisticuffing with IP and China is fisticuffing with rare earths. We are in a much more balanced world than we were over the last few years. And I would suggest because of that, and you've seen the Chinese stocks move, and the Chinese are the ones that we need to buy their own stocks, and they've started to do that. That is what has changed. So I think this relative valuation doesn't make a lot of sense, and the premium on US is just too high. Last thing I want to point out is that the big reason in 2024 why Japan ran is because Topics, the exchange, at the beginning of the year, came up with a rule, and they said, your price to book must be close to 1. It was an easy way to make directors really manage capital more efficiently. The same rules have been, and then you saw Japan was the strongest performer, one of the strongest performing markets in 2024. This year they've done incredibly well as well. I think it was up 16% 2 months ago, in 1 month. China is doing the same thing because governance and being clever about how you manage your capital is about paying dividends. It is about buybacks. And you still haven't seen that come through as strongly as you saw in Japan. I just think that at some stage, if you're in a market where it's a duopoly, you are going to see that those valuations are going to come closer together. And if in your portfolio, you've got developed markets, you're making a binary decision against China. And it's not going to be a binary answer. It's going to be a degreed answer. So it's important to have some of that other exposure, emerging markets, China, in your portfolio to reflect closer what's going to happen. Yes, keep your very expensive stocks, but certainly in all these areas, there's far more competition from EM and China. Keep some exposure there. And a 0-1 is not the right structure. I think that's where I can leave it. Hope that's helped.
Thanks, Jared. I'm actually aware that people seem to still be with us. So we've obviously struck a bit of a nerve with our audience. So if you'll indulge us for a couple more minutes, we do have 1 or 2 more really interesting questions. One of the questions that's come through from a handful of people is, in various forms, have we missed the boat? Right, the Chinese markets are up quite a bit this year to date. Valuations have improved. Active returns have come through. We've heard a lot about some very successful companies that have come through. Kind of what's the next step? Like, is there still an opportunity for someone who's entering now? Do we have a view on what someone who's thinking about a China allocation now should be considering?
So let me climb in on that one quickly, Lars. I mean, this is something we've done a lot of work on. Yes, there's been quite a nice performance. I mean, China's up 40%, Africa's up 40%, EM is up 35%, and the US is only up 20 odd percent this year. So the more you hear on how well the US is doing and how many times they're hitting their new highs, the actual performance in a constant currency has not been quite as high as the balance. But this is just the start. And what you can see there is the most important, there are two drivers here. The first one, the most important one, is emerging markets, China, frontier markets, which would include Southeast Asia and Africa. It's across the board. Do better than the developed markets, primarily the US, when the dollar is weak. And the dollar is, and Trump has promised this. Trump has promised a weak dollar. He's getting a weak dollar, and we've seen the dollar is weak. That there adds fuel to the performance of everything else, and it slows down performance of the US stock. So if you look at the graphs, there could very easily be a 15-year cycle where the dollar depreciates 30% relative to a basket of currencies. It's quite easy to do. Why? Because it's been this expensive in kind of 3 occasions. So if you like, before the fall of the Berlin Wall, Bretton Woods, and tech bubble, those were where the dollar was this expensive. Even the GFC wasn't quite as expensive as it is now. We are now at a super premium dollar, and Trump needs it weaker because it's stifling competition of the US. That there will give, if it's 30 for 15 years, that gives you 2% performance just on currency. Then you have to go and look, your prices are half in China everywhere else, certainly relative to the US, but probably roughly where everything else is. But your earnings growth is far higher. I would say this is broadly the same thing for India, which would make EM interesting. But the problem is India comes from a price which is very similar to the US. But let's stick to China and the US. So you have half the PE, growth which is 25% higher than the US, and you have that in the long term. This outperformance is driven by currency, a third, by higher economic growth, a third, and that leading to company growth of a third, a fix up on governance and capital management, and let's just say that's kind of a sixth, and then your last sixth is just because you've got this valuation discount, and you're getting all of these things wrapped up in one innovation. It's just so cheap. Ultimately, this is just the start. If you're worried about what you've missed, it's just the start of that change, because it's still now we're down 40%. We were down 50% of China versus the US till a few months ago. With the kick up that you've seen in China, it's down 40%. This has just started. And when they were together, you still had the US at a premium of 30% PE to China. That was in 2020, 2021. It has still got to make all of that performance back. So I would just suggest this is right at the start. And again, your binary portfolio has none of China or EM in, I suspect. And it should be closer to a 30, 40, 60% split, just because of the dollar cycle we're going into.
All right, there's some bullish words there from Jared, but I unfortunately I'm forced to agree with you, right? That actually the opportunity is there, the numbers, the stars just align. But anyway, we are quarter of an hour over time. I'm very grateful for all of you for sticking with us for so long. Clearly, the topic has been interesting. As we see on the screen, we'd love to continue the conversation with you about how a China allocation might fit into your portfolio. There's a web link that we've put up on the screen there. Maybe just to write it down, Unbox China on our website. Otherwise, get hold of someone from Riskura or look us up on our website. We'd very much love to continue to talk to you and see whether there's a way that we can help you understand the Chinese market, understand how it could fit into your portfolio. We have some products that might be ready-made for you, but otherwise, on an advisory basis, we're very happy to continue that conversation. So thanks everybody for joining us this afternoon. Hope it's been useful. Those who did submit questions, we're going to try and get hold of you directly and answer those. Otherwise, again, thanks everybody for joining us.
Thank you, everyone.